world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by Samvit Ramadurgam and Kelly Rodriques. Samvit is the co-founder and president, and Kelly is the CEO of Forge, a secondary market for private shares. Forge provides access to shares of virtually all of the top 50 privately held tech startups and offered trading in the likes of Spotify, Dropbox, Snap, and DocuSign before they IPOed. According to Crunchbase, Forge has raised $88.5 million from investors including Peter Thiel, Tim Draper, FT Partners, and others. Unlike earlier players in the secondary market for private shares space, Forge is focused on building out a robust technology platform, including institutional-grade clearing and custody infrastructure to support global counterparties. Forge's proposition is particularly relevant as companies stay private for longer. More investor value is captured pre-IPO, so access to private shares is important. Additionally, because IPOs happen later, early employees are often unable to access liquidity for years, making it difficult to buy homes or diversify risk. We dig into all of these issues with Samvit and Kelly. In addition to the insights we deliver through our podcast and newsletter, Rebank offers advisory services to fintechs, banks, and corporates. Drawing on our experience starting, running, and advising fintech businesses, and our vast network of the most impactful fintech entrepreneurs, investors, and innovators around the world, we help companies make sense of fintech, work through specific questions, and optimize proposition and strategy. For more information about our services, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Samvit Ramadurgam and Kelly Rodriques. Kelly and Samvit, welcome to Rebank.
Thanks for having us.
Thank you.
Yeah. All right. So maybe for context and kind of to introduce everything to the audience, quick intros on you guys and Forge.
Why don't you start?
Sure. So my background, I originally started coming from engineering at Berkeley. I went through Y Combinator for my first company. Started a company called Stream, which ended up selling to Box, which actually was my first interaction with pre-IPO stock. After having that experience, me and my now co-founder Sohail, we started a fund called S2 Capital, where over the last 6 years we've invested in over 130 early stage companies. And a time came in 2013 when we'd become close friends and we were discussing kind of our view on the market. And we simultaneously had a desire to get access to late stage companies, late stage tech companies, as part of our investing. At the same time, us and a lot of people in our social network had a need for liquidity because we'd been part of early stage companies. And really, if you look at kind of the ecosystem we're part of, if you touch a private company as a founder, investor, employee in any way, you end up being compensated with equity in these companies. And it's a fundamental issue that we felt ourselves of the liquidity. So in 2014, we started the company. It was called IPOed at the time. Now we're called Forge. And we were focused on letting people get liquidity in equity in private companies, letting investors get access. Over the years that followed, we grew from being focused on individuals to, after a couple of years, working more closely directly with companies, directly with funds, families, institutions, hedge funds, et cetera. And kind of coming into 2018, we were a company that was pretty decidedly an institutional-focused company. We raised money early on from some angel investors who were close friends of ours, and then for a Series A from Peter Thiel and Tim Draper. And then in 2018 was a big year for us. We raised our Series B, and more notably, Kelly joined our team as CEO. And I'll let Kelly share his background.
So I had familiarity with IPOed previously, and several of the companies, including Second Market back in the day, and had formed a thesis while running another company that the world needed a private markets institution. It needed an institutional grade provider of services beyond just the transactional capabilities. Now, I had previously been the CEO of 4 other venture-backed firms. I had typically been brought in after founding my first company as a guy that would be the next generation CEO, usually with founders still in place. And for about 4 years, I was in a large global venture capital firm. I came back in to operate the last company, which I sold in 2016. And during that time, formed a lot of the thesis for the basis of what Forge is now. I met Samvit and Sohail in 2016, and we really put this plan together in 2017. So in 2018, what we look like coming out of this year with the new name and an expansive service offering is we believe fundamentally that we're not only solving a problem of liquidity and access, but at scale, large institutions need to have a robust trade settlement capability, custody in terms of a regulated bank-like partner that can hold securities, hold cash, and be a persistent place where people can hold accounts or institutions can direct their clients into accounts. And then finally, the asset management component, which was essentially underlined by the announcement with BNP. That sort of makes up the ecosystem as we see it. The BNP news is particularly interesting because it represents access to a basket of companies. So the world may not always want to invest in a single issuer. They may see this as an asset class play. And this is going to lead to, I know, other questions we can get to in a second. But Forge came out of 2018 as clearly the market leader in secondaries, and we're now starting to see the lines blur between secondary and primary capital raises.
Mm-hmm, mm-hmm. So the BNP news, just for those who haven't seen it, it was basically an equity investment by BNP in Forge and the kind of collaboration on a structured product, right?
Right. They are a material part of our Series B, and they wanted to provide access to the asset class through their structured product. Now, they're experts in this. This is something that they've been doing over the years, and they've got very specific expertise in Europe, Asia, South America for that kind of a structure. And for them, it was a sort of a perfect marriage. They wanted to be partners with who they thought of as the most reliable platform in the world to do it, and we wanted to be partners with a firm that had one of the biggest balance sheets in the world and access to investors that in other parts of the globe where we weren't present could make that connection.
So you mentioned Second Market, Kelly, previously, who have been in the space. I think they were acquired by NASDAQ at one point. So what makes Forge different than some of its predecessors, some of which had pursued this concept but maybe been a bit more hit and miss?
Right. So I've been familiar with them. I was close to Second Market at my previous company. I think there's two things that are different now. One is fundamentally the market has changed. The Facebook IPO and what happened when Second Market came on the scene was really the first sort of chapter. And even then, companies at large weren't interested in necessarily facilitating liquidity. There weren't as many private large firms as there are now, and so it was pretty nascent. So the market has evolved considerably. We now have close to 350 companies in the world that are private and valued at more than $1 billion. The top 40 companies that trade on our platform are all valued at $3.7 billion or more. And so part of what's shifted is that this is a lot bigger, and the market is embracing it. What we've reacted to is the need for institutional grade technology in order to do this. I would say SharesPost and Second Market looked then and look now like just a conventional brokerage desk trying to match buyers and sellers. The complexity of bringing $50, $100 million checks into these private firms where there's one or two buyers and 170 sellers with different classes of stock requires a technology component. In addition to that, the level of data and sort of technology that a company can use to manage these programs has also evolved. So when we stepped into the scene, Samvit and Sohail were 4 years into this, and we came together and decided, let's build technology that solves scale problems. with this as a large global problem that needed to be solved. So the technology and the market changing really created the timing for us to exploit the market.
And I'll add on to that, and that going back to even when we first started talking to Kelly, one thing that was a very big thing that aligned us was culturally we shared a vision to go and build a company that would endure for the long term and take a long-term view on how we operate, how we interact with other people in the market, like companies and institutions. And that shapes a lot of how we've run the company from the foundation in 2014, and now how we have a long-term view. If you take the example of us working with BNP now, there's a lot of kind of years worth of work in terms of us getting our foundations built around compliance and architecture and legal foundations and infrastructure to make it so that we could have a product that was actually something that could work with an institution of their caliber. And not just on the institutional side, but also with companies. When we work with companies, we see ourselves as partners for them, giving them a channel into the capital market at a scale and kind of ability that previously wasn't there. Mm-hmm. And for companies, I think that they're starting to see us as not as this distinct from the existing kind of market of people who look like brokers. I think that we look more like a tech company that they can partner with to get access to this. And that long-term view permeates kind of every decision we make at every level of the company and leads to some pretty meaningful outcomes once it all starts to compound together.
Yeah. So I think one of the things that makes Silicon Valley uniquely powerful is that there have been exits over time, and there's been liquidity recycled back into the ecosystem, and you guys are kind of supporting that and enabling it to happen more quickly, which is hugely powerful. For listeners maybe outside of the Valley who have less experience with the way that early stage shares generally work, Kelly, you mentioned multiple classes. Samvit, maybe you can talk to this point given your previous experience. How does kind of early stage employee equity generally work?
Well, I think that what you're referring to is actually there's a world of early stage, and there's a world that a company hits going across the Series C, where I think the dynamic, usually it's around the Series C, where some of the fundamental dynamics of the company change, and they become a growth equity company. When a company is founded, the equity is owned by the founders and the early investors, and then team members who join as early employees are given a piece of the company as compensation. That may be in the form of stock directly or stock options, or later in a company's lifetime RSUs. At the end of the day, people have ownership in the company, and the company is going through a period of kind of high risk, high illiquidity, high volatility, and it's being formed. When you kind of come to the Series C-ish stage, you have companies that have what I'll call like well-formed businesses. Like they have kind of predictable revenue, they have a clear plan, they have a pretty clear view into kind of where they're headed from there, and there's a lot of options for them to kind of go and either kind of continue as they are or go and really grow into scale and enter a mode which some people call it the hyper-growth phase. It's at that phase that the company enters kind of really the market that is the market we're focused on helping. And their dynamics are different. There are employees who've been there for a while who now have real life needs, like they want to buy a house or get married. There are investors who have been with the company for, in some cases, coming close to a decade, and there's need for liquidity, and there's a global market of investors, which the company would benefit from having access to, both strategically and in terms of direct capital, in terms of their fundraising and secondary financing. You also have concerns start to come up around employee retention and attracting talent at a scale that previously wasn't a problem for the company because you're directly interacting with the early team members. And so it's this new class of problems that changes some of the dynamics that are fundamental to equity in the company and how it works and how it looks. And I think that's the switch from kind of venture capital to growth capital mode is one that a lot of companies stumble across when they cross it, because they're still operating like a venture capital backed company when in reality they have to interact with a different kind of ecosystem. And I think that fundamental shift is something that's new. It didn't exist in a decade before now, and that's really the change that we're a part of.
And can you just kind of walk us through the logistics of getting privately held shares kind of onto a trading platform, if that's a fair description of Forge?
Yeah, I think that we work with companies in a pretty wide variety of ways. The one that we've found that has been exciting to a lot of companies that we've talked to recently has been the company is now at a stage where, let's say they're a unicorn, and they've come to the conclusion that their employees who, if given liquidity and given kind of the visibility into future liquidity, would be kind kind of would see the opportunity of joining their companies de-risked, and thus make it easier for them to attract and retain the talent that they require to go and grow and scale. And so companies are coming to the conclusion that if they can find a way to work with the market and find a solution to enable liquidity for their employees in a way that aligns with their strategic goals, then they'd be benefited. And so if you're asking specifically, like what does that world look like for equity, and how that administration works when companies actually go and when the equity starts becoming liquid, the example that we have with the number of unicorns we're working with right now is the company will, depending on the company, introduce us to the department that's managing the equity cap table for the company, and we can go and interact with that system and offer the employees liquidity under the terms the company wants. Mm-hmm. And from there, that can align with the company's fundraising. That can be something that's done on a repeating interval program, not tied to the fundraising. It really depends on what the company wants.
Mm-hmm. Can you give any examples of companies whose shares trade on the platform?
I mean, most of the top 40 companies in the world trade here. Mm. So right now, you'll see volume expand in a name that's closer to an IPO. Yeah. So Slack, for example, is a high concentration of trading activity in our Q1. Mm-hmm. They have been rumored to plan their direct listing as early as June. But last year, we were between 40 and 50% of the global volume of Spotify around the world in the last 90 days before they direct listed. But if you look at the top 50 unicorns in the world, most all of them trade here now.
What are the implications of more value being captured as companies are private rather than once they've IPO'd?
Well, I mean, the BMP news is really a broader story of the world getting into companies before IPOs. I mean, we didn't mention this at the beginning, but the average age of a new IPO in this year is about 12 years. And if you think about the top 50 companies being worth over $3 billion each, those companies would have been public years ago in historical sort of market environment. And so now, if companies or investors around the world are interested in being in an innovation company, they can wait 10 to 15 years, or they can try to get in and get access earlier in the cycle relative to when these companies are still private. So that does change where capital comes from. And it also provides access at an earlier stage than what the rest of the world would normally have had access to. The venture world at the same time has moved up, and so now you've got essentially an emerging convergence of interest in these companies while they're private. And so we, again, are facilitating that and trying to be the infrastructure and the friction reducer of that phenomenon.
It feels like you guys are kind of facilitating the creation of a new asset class, right? Like it's a type of equity investment that wasn't previously available.
Yeah, it was available to a small group of people who managed it very carefully, and unless you were an investor in those funds, you would not be able to reach it. I want to point out too that part of what we see our vision as here, and Samvit touched on our work with companies, we really started that last year because the market up to then was really a brokered market with very fractured pockets of liquidity being accessible. What we see now is we see ourselves as enabling innovators, that great companies will take a time to build, and being private affords those innovators, to the extent they've got liquidity and time, the opportunity to build great businesses over the span of a decade.
Yeah, without focusing on quarterly earnings. And
right. We think that companies should choose to IPO when it's kind of strategically the best move for them, and not because there's some pressure, either because the people need liquidity or the board has the pressure to give them liquidity or things like that. Mm-hmm. Enabling companies to have the option to have liquidity earlier gives the founders and executives more agency and lets them be more innovative at a fundamental level.
Sam, but maybe you touched on it before, but so certainly scope for trading existing shares. But the platform, it sounds like, given the institutional relationships, companies' funding needs, can also be a conduit for private placements, kind of a more institutional style sourcing of funds, different from the traditional kind of venture type rounds. Has that either happened on the platform already, or is it something you guys are considering for the future?
We see ourselves as providing more options for companies. We are seeing the lines blur between primary and secondary capital raises, and are already involved today in a handful of transactions where secondary and primary are happening at the same time. Mm-hmm. We don't see ourselves as the primary pricer of a private placement, or replacing an investment bank, or leading a round per se. But we certainly look like a firm that a company should look at and say, Forge provides me with an expansive capital access platform. We just have to decide as a company who we want to price it and how we want to allocate liquidity and access beyond that. Mm-hmm. And so we see ourselves as additive to the ecosystem. We're not necessarily trying to disrupt.
Well, look, it's a massively transformative proposition, and I think something that the market desperately needs. So, congrats on all the great work so far, and all the best going forward. Kelly and Samvit, thank you very much for joining us today.
Thank you.
Thank you, Will.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.